How safe money became the riskiest bet. It was supposed to be the quiet corner of the market, the place where money went to rest, not a gamble. Then, slowly, almost invisibly, that assumption began to collapse. To understand why this story matters today, we need to return to a time when safety itself became a strategy. Interest rates were falling. Inflation looked contained. Growth was steady but unspectacular. For investors managing vast pools of capital, the problem wasn't fear. It was boredom. Traditional safe assets no longer paid enough to justify holding them. At first, the response seemed reasonable. Investors searched for alternatives that felt familiar, instruments that carried the language of safety but offered slightly higher returns, bonds that promised stability, products labeled low-risk, conservative, defensive. They weren't chasing profits. They were trying to preserve certainty in a world where certainty paid almost nothing. This is where the transformation began. Safety stopped being a condition and became a label. What mattered wasn't how an asset behaved under stress, but how it appeared during calm periods. Models emphasized volatility over fragility. Ratings focused on history, not structure. If something hadn't failed before, it was treated as unlikely to fail at all. As capital poured in, these assets grew larger, deeper, more accepted. Pension funds adopted them. Insurance portfolios leaned on them. Entire balance sheets began to depend on the idea that these positions could always be exited smoothly. The logic felt sound. These were not speculative bets. They were engineered solutions to a low-return world. But embedded within this shift was a quiet contradiction. The more money that chased safety, the more fragile safety became. Liquidity looked abundant only because nobody needed it at the same time. Risk appeared low only because stress had not yet arrived. At first, nothing seemed wrong. Returns were modest but reliable. Losses were rare and quickly reversed. Confidence didn't surge. It settled. And that calm, persistent confidence is what allowed the next phase of the story to unfold. Because when everyone agrees on what safe money looks like, the market stops asking what happens when it no longer feels safe at all. As these instruments multiplied, the definition of safety quietly shifted again. It was no longer about resilience during stress. It was about consistency during normal conditions. Assets were judged by how rarely they surprised, not by how severely they could fail. Smooth charts replaced hard questions. Financial engineering accelerated the process. Structures were built to slice risk into pieces that looked manageable. Senior tranches appeared insulated. Cash flows were modeled to remain stable across most scenarios. Complexity wasn't seen as danger. It was seen as protection. Each layer added confidence, not caution. Regulation reinforced this perception. Capital rules rewarded assets with favorable ratings. Balance sheets improved by holding instruments stamped as low risk. What began as a defensive posture turned into an incentive. Institutions weren't merely allowed to hold these assets. They were encouraged to. As demand increased, yields compressed further. The safest-looking assets became the most crowded trades in the market. Everyone wanted exposure, not because of belief, but because of necessity. Large pools of capital needed somewhere to sit, and these instruments seemed designed for exactly that purpose. Yet something subtle was happening beneath the surface. Because these assets were treated as safe, they were financed aggressively. Leverage crept in, quietly justified by stability. Short-term funding supported long-term positions. Small yield differences were magnified through scale. Risk managers watched volatility remain low and felt reassured. Stress scenarios assumed liquidity would always be present. Correlations were treated as stable. After all, these were not speculative markets. They were the backbone of institutional finance. But safety, when universally accepted, stops being questioned. Nobody asked how these assets would behave if many holders tried to exit together. Nobody tested what would happen if funding conditions changed abruptly. The very success of the system discouraged curiosity. What made this stage dangerous was not ignorance, but alignment. Everyone relied on the same assumptions. Everyone trusted the same signals. Safety was no longer diversified. It was synchronized. And that synchronization meant that when pressure finally arrived, it wouldn't test one portfolio at a time. It would test the idea of safety itself. The conflict emerged when conditions changed faster than assumptions could adapt. Funding markets tightened. Small rate moves began to matter. What once felt like background noise started to affect prices in visible ways. Spreads widened, volumes thinned. The system noticed, but it did not yet panic. Managers responded rationally. They reduced exposure at the margins. They adjusted hedges. They sought to rebalance without signaling urgency. But the market had changed character. Trades that once cleared instantly now required time. Prices moved before orders finished. As stress increased, the logic of safety began to invert. Assets labeled conservative started behaving unpredictably. Their structures, designed for calm, resisted adjustment. Cash flows remained intact on paper, but market values slipped as buyers hesitated. Leverage turned from helper to accelerant. Small declines triggered collateral calls. Funding providers shortened terms. What had been stable financing became conditional. Institutions that believed they could hold indefinitely discovered they were being asked to choose. This is where the paradox revealed itself. The assets considered safest were the hardest to exit quietly. They were too widely held, too similarly financed, too deeply embedded in balance sheets. Selling them meant signaling stress. Not selling them meant absorbing losses. Each attempt to reduce risk increased visible pressure. Prices moved further. With each transaction, liquidity, once assumed constant, became selective. It appeared only at lower prices, and only briefly. The market was not frozen. It was cautious. Confidence, built slowly over years, unraveled in weeks. Not because of fear, but because of arithmetic. Positions sized for stability could not shrink without impact. Systems designed to absorb small shocks struggled with persistence. By the time the conflict was undeniable, it was no longer about individual assets. It was about structure, about what happens when safety is optimized for normality instead of resilience. The buildup was complete. The market had reached a point where maintaining the illusion of safety required more risk than abandoning it. The turning point came quietly. No single headline marked it. No dramatic collapse announced a shift. Instead, markets began to reprice safety itself. Instruments once treated as immovable started trading like opinions, not anchors. What finally broke the illusion was realization. Safety was never about labels or ratings. It was about behavior under stress. And when stress arrived, these assets behaved like everything else that had been optimized too far. They resisted change, then adjusted all at once. Institutions that believed they were protected discovered they were exposed in the same direction. Diversification failed not because it was ignored, but because it was assumed. Everyone had diversified into the same idea of safety. And that idea could not hold under pressure. Afterward, explanations followed. Complexity was blamed. Incentives were questioned. New frameworks promised better measurement. Yet beneath all of it lay a simpler truth. When safety becomes crowded, it stops being safe. When certainty is treated as a resource, it gets consumed. This story matters because it continues to repeat. Every era creates its own version of safe money. Different instruments, different structures, the same logic. Calm conditions reward strategies that minimize surprise until surprise is the only thing left. Markets do not punish the search for safety. They punish forgetting its cost. True resilience is rarely smooth. It looks inefficient. It feels uncomfortable. And because of that, it is often ignored. Sometimes the smallest shift in perspective becomes the beginning of a new future. How